Good morning, and thanks for coming to our Benefits and Compensation University webinar, Hot Topics in Executive Compensation. This is the first of 4 webinars that we're going to have under our Benefits and Compensation University for 2022. I'm Debbie Hoffman. I'm a partner in the Employment and Benefits Group at Mayer Brown, and I'm joined today by my partner, Ryan Liebel, who's also obviously a partner in the Employment and Benefits Group at Mayer Brown. We're both in the Chicago office of Mayer Brown. Before we begin, I'd like to cover a few administrative matters, which I'm going to read to you, and it's the only thing I'll read all day, but I don't want to mess anything up. So when accessing Mayer Brown webinars via our Zoom platform, we suggest avoiding software such as Citrix to decrease disruption of quality loss. If you are applying for CLE credit, we will provide an alphanumeric code during the presentation. Please record this code on the CLE affirmation form, which can be found in the connection details email that we sent yesterday. The form will also be mailed to you within the next day or 2 following our program. The email will also include links to a recording of today's program and an evaluation form. The evaluation form can be found in the same file as the CLE form. Even if you will not be applying for CLE credit, please complete the evaluation so we may continue to provide meaningful content. If you have any questions during the presentation, please let us know via the Q&A feature on the bottom of your screen, where you can type your question to the Q&A box. We will do our best to address questions live or after today's program. Without further ado, let me turn it over to Ryan, who's going to talk about our first topic, pay versus performance disclosure. Ryan?
Perfect. Thanks, Debbie. So, these are our overall, without further ado, I like the phrase, our hot topics for 2022. So I guess those of us in the nerdy world, we have the Nobel Prize for Literature announced this morning, and now you had to wait till 10 or 11 if you're on the East Coast to hear the hot topics for the day. But for those of you in the public company space, the pay versus performance disclosure is really dominating right now. And luckily, we do these presentations every year at this time. And honestly, it's a perfect time to talk about it. I think we'll go through it today. It obviously overlaps with securities rules. And so you'll hear about that from our securities colleagues as well, but it's requires a lot of work, and clients are getting started now, and we'll go through it today so everybody has a sense of what's going on. And then I think particularly Debbie and I would like to focus on the compensation aspects and some key questions that I think clients will have to dig into. Debbie's going to cover the tax on redemption of securities, also a public company topic. Not getting as much discussion, but there are some sneaky issues there that we definitely want to make sure you're all aware of. Clawbacks are never going away. Again, we think that final rules will finally be coming out, so we definitely want to update on that. We'll do a few cases, and then we want to cover some topics that are coming up more frequently for private companies and sort of do an overview of the lay of the land on exec comp for private companies. There's big differences between different types of companies, but then also hit some specific issues for different types of companies that we're seeing and want to make sure there's awareness out there. So, okay, slide. Okay, so pay versus performance. So I laugh. The one thing I want to focus on even first is just a linguistic point, but the linguistic point is important, I think, to see where this is heading. For those of us in the comp world, I think we've heard the phrase forever now, pay for performance. Everybody in the world wants to pay executives for performance. There's a million different ways to measure that. There's a lot of debate about the right way to measure performance, but it's always pay for performance. And in your CD&A, if you're a public company for years and years now, you've most likely articulated a theory of how you're working to pay executives for performance. So here's the semantics point that I think just drives home what's going on here. And also, I think if you take nothing else away from this today, make sure you catch yourself in how you're saying this to show you're with the lingo. This is pay versus performance, which again is the whole point. It's the scorecard. There's no public company universal scorecard for investors to stop and evaluate whether they agree that you're actually paying for performance. And so this new disclosure requirement, pay versus performance, is a way to try to objectively set universal rules that will require all public companies to actually disclose. This is what we're doing. This is what we're paying, and does it or does it does it or does it not align with performance based on objective criteria? So, anyway, I think that overall really captures what's going on here. It's just the switching of one word, but that one word really captures the change. The other thing that's ironic here, or at least worth pointing out, of course, this is still rulemaking based on Dodd-Frank, which was passed now 12 years ago and has been around forever. There was proposed rules in 2015. There are significant changes, but I think a lot of us know the political climate that led to the delay, and that now is sort of pushing through some of these rules that also are lining up that we think will finally get the clawback rules passed. But notwithstanding the delay, the new rules just came out, the final rules came out, but their compliance is required for the upcoming proxy season. And as we get through this, you'll note that there are just significant work streams that need to get started because there's certain things that companies haven't done before that will need to be accomplished to comply with this. So, it hit the ground and now everybody's up and running. Okay, slide. This is a very high overview. We're going to get into a lot of different points from this slide. There's a new table, which we'll show you in a minute. There's a clear description requirement for what the compensation actually paid to the PEO and other NEOs. It's an averaging for other NEOs against certain measures. And a key concept that we want to spend some time on today is what does it mean for compensation actually paid? They took a new approach in the final rules compared to what they did in the proposed rules. So we'll spend some time on that. And then a tabular list of the most important financial measures that a company uses to link NEO compensation to company performance. So that's a high level. Let me pause there and see if Debbie wants to jump in on anything.
Yeah, Ryan, it seems like this is a lot of changes, and I'm sure you'll get to some of these things, but it seems like the company can still decide what performance measures it's going to use. And then this disclosure is disclosure against what I'll refer to maybe pejoratively as arbitrary measures that are in the rules. And so the point of the disclosure is to describe what you did versus this kind of standardized approach to things. Is that right?
It is, and it's interesting because I think, a lot of times it's like for a client, you're going to want sort of the disclosure that makes the company look best, and how can we come across best to our investors. And interestingly here, I think that the bad scenario that a company will want to avoid, but it may happen, which is these objectives criteria selected by the SEC point down during a year when the comp looks like it's gone up. And that's the thing that's going to raise, I think, investors' concerns. The problem is, for companies that use these same measures that the SEC is focusing on, that should be mitigated, because as those measures go up or down, the comp should go up or down. And we'll get through how that'll work. But if you're a company that hasn't used TSR historically, or relative TSR, or something else that they're sort of selecting, then there's more of a chance of being an outlier. And it's the outlier situations that I think, like every public company, when you're discussing comp, you don't want to be an outlier. You generally want to blend in with everybody else and not stand out. So we'll get to that. I agree. I think it's going to be a lot of change. And I think overall, as always with this first year or two, it's going to be interesting to see what comes out and what different companies do. But I think it's going to involve a lot of change for a lot of companies, a lot of new numbers. So, okay. Yep. Slide. Okay. So here's the table, and actually just jump to the next slide where we have a picture of the table. This is the table. I mean, a lot of you have probably seen this. It obviously encapsulates a lot of the rules, but it's a summary comp table amount for the PEO for the last 5 years. The comp actually paid, which we'll get into how you figure that out. Average for the non-PEO named executive officers from the summary comp table, and the average actually paid. And then you will also have a TSR and a relative TSR based on an assumed $100 investment. The TSR is cumulative over the years. So you go back to the first year reported, and then it's TSR over those years. So in this case, you would start 5 years back and go forward for your TSR each successive year, whereas net income and then the other company selected measure it's the measurement for that any given year. And anyway, we'll go into more of these rules, but I always feel like it's helpful to sort of see the visual of where this is heading. So go ahead, slide. Okay, so then these are the goals we just talked about, that the company TSR and peer group TSR will be what goes in the table, company net income, and then a company selected measure. And again, my point being, mathematically, these are mathematical measurements. The company selected measure. The comp is what it is. The more your comp lines up with these measures, the less of a chance you have to be an outlier, just mathematically, right? And so I think one thing I always note with companies is one of the things you have to select is your company selected measure. And in my mind, it's likely going to be whatever measurement carries the most weight in your comp program other than TSR and company net income, whatever. So maybe those aren't even your most important. So you select the one that is the most important. Or if you use one of those, you select the next most important one mathematically, because that will increase your chances. And honestly, to me, at least, it's hard to argue your most important one is not the one that's the most weighted. The only part that's a little tricky there is you may have one that's the most weighted for your annual program, which may be different than the one that's most weighted for your long-term program, in which case I think you have to debate which one's more appropriate here. Okay, slide. So then there's a tabular list that's separate from the table where you list the 3 to 7 most important financial performance measures. And this is just whatever you use. To me, at least, I think it shouldn't be hard to assemble this list in terms of just whatever you actually use for your annual programs and your long-term programs. What are the metrics you use? And you'll list them out. The part I want to note here, and I'll make the point on this slide, I think it's a good point to tie it in, is that the one thing I feel like this table overall is in tension with for public companies is the rise of ESG metrics. So more and more public companies are under increasing pressure to tie some elements of compensation to one or more ESG metrics. And I think as now this table is intending to compare compensation to financial metrics. And again, you might use one of those ESG metrics or listed here as a non-financial metric. And I think companies just have to consider the way they want to balance those sort of two different needs or two different sort of pressure points for public companies. Is a lot of public companies want to look responsive on different ESG metrics. And I think that that's great. I think you just have to consider how you'll disclose for this table and sort of weigh that against an ESG metric that might not be a financial measure, or and how you're going to kind of capture all of that. So I think there's a tension there. There's going to be a lot of work to be done. I think more and more companies are trying to balance that. But that's at least one thought I have here. But otherwise, I think the tabular list will just generally be whatever you actually use. So let me pause. I don't know, Debbie, if you want to jump back in on anything.
No, I'm good so far. You know, I'm not going to be shy.
Okay, good. And I did want to note, I've got a couple of questions on the Q&A. I'll just tend to hit Q&A questions as I go if I can. One was a question about presentation materials being available. And generally, yes, the slides and the recorded audio will be sent out. So any of you joining in will get the slide deck. Okay, slide. And I won't spend much time on this. This is the company's covered. Next slide. So filings covered. And then next slide again, 2 executives covered. I won't spend a lot of time. I think these are generally concepts public companies have spent a lot of time on. So nothing too surprising there. Okay, then the next slide again. Here's where we get to the math on the comp. And this is all new. So as many of you know, the summary comp table takes a different approach for equity than it does for cash. And the equity is the fair value on the date of grant, whereas cash is, of course, the salary that was paid during the relevant year, or for a bonus, it's the bonus that was earned with respect to that year. So most of my clients report the bonus the year after, or the year before it was paid, but the year during which it was earned. In the way that the math for this table works, because the SEC is concerned that the fair value on the date of grant doesn't show actually how the equity awards play out. So for PSUs, for example, that have performance goals, it doesn't show if there's a lack of performance that the executive actually ends up forfeiting some of those PSUs, or if performance is great, that they, as a lot of public companies do, they may earn over 100%. And this table is intending, is their work to try to show the rest of the story against actual performance. So the way at a high level this works is you take the summary comp table total for the given year, and you subtract out three things: the pension value, which we'll get to in a minute, you subtract out the equity value, and then you subtract out if you have any above market or preferred earnings on deferred comp. All of that comes out, and then you add back in these new values for this table, which we'll cover now. So
Ryan, before you go on,
yeah,
I noticed that you say here, and you mentioned it earlier too, that the standard for this is quote unquote actually paid, but really it's not that, is it?
no, it's a good point. And there's several different points in these rules where those of us that are coming at these rules from the comp side, I think, at least for me and my wiring, it's always intended to read these concepts with a tax meaning. And so to me, actually paid would be the year in which it's includable in W-2, like it's compensation. It's the year you pay taxes on it. And that is definitely not what they mean at all. They're more going here for trying to align concepts of when they feel like it is earned. So for the equity, they use vesting concepts, which we'll get to, but not taxable income, or not necessarily even when the shares are actually received. And for options, a similar concept, it's the vesting of the options, but not when they're exercised, which would be the taxable event. And like for the deferred comp here and the pension benefits, also it's the amount allocated in the year conceptually, but not the amount that's actually paid or included in income. So I completely agree that the concept of paid, at least in my mind on the comp side, means taxable income, and that is definitely not what they mean here.
Do you think companies are going to want to do a voluntary disclosure about what actually is maybe realized versus what's shown in this table?
It's a good question, and a lot of companies over the years have voluntarily tried to show their own take on what would be sort of earned income over years, different than the summary comp table, to try to show what's actually realized over the years. So there's a lot of different companies that have sort of taken their own approach over the years to show realized income compared to the summary comp table. But I think at least, if a company hasn't done that historically, I think complying with this rule the first few years will likely be enough. But if a pattern emerges for a company that they feel like what's required for this rule doesn't tell the whole story, I would definitely see companies wanting to tell more of the story. But when you tell more of the story, companies are going to have to be careful that it's not misleading, and that it's not taking away from what the SEC is requiring in these rules. And then I think for companies that have historically done that themselves, I would think at least for the first year or two, they may want to continue their own methodology and then contrast it to what's required here. But it will require a lot of work to really explain, and maybe they just want to do away with that and just comply with the rule. I don't know, because I think to not be misleading, if you do it on your own with a different approach, you're going to have to be very, very careful that you're clear to investors how different your approach is, and the way that the calculations are done, so that investors can clearly try to compare apples to apples, so to speak, and know when you're deviating from the rules very clearly. Okay, slide. I won't spend a lot of time on this. The pension benefits, for any companies that have a pension component, either qualified or non-qualified for NEOs, I just would recommend you get your actuaries working on this. So you had a value that historically has been included for the summary comp table that will come out, and then there's this new value that has to be calculated. And my understanding, I am definitely not a pension expert, and Debbie, you can jump in if you have a better sense of this, but from my understanding, what is required here is not something that's historically been calculated on an individual basis. It's something that may be calculated on the plan basis, but not broken down by individuals. So I think you would need your actuaries to run new calculations that they haven't done historically. So this would be one I would get your service providers started on if you haven't already.
Yeah, I mean, the actuaries clearly can do it on a case-by-case basis, and they have to do it for certain purposes, but not this. So I agree. Pretty much on this and the rest of this stuff, it seems like there's so much difference than what we've had in the past that, and I'm sure you'll get to this, but starting early is probably better than not.
Yeah, next slide. And I agree, for equity awards, at least several companies I've talked to already are getting outside help for some of these new valuations that are required. So if you haven't started that discussion with your internal finance group or internal accountants and whether or not they want to get external help for doing this, I agree. I would start that conversation sooner rather than later, because every public company suddenly needs these new values that they've never calculated historically. And there's only so many people that do these calculations. So I think getting in line to make sure it's going to get done on time is a good idea. So for equity awards, I want to note this is the final rule made a big change to the proposed rule. The proposed rule was going to consider an award as earned in the year in which it became vested. And in the year in which it became vested, that amount, then the fair value would have been recorded. And in the guidance, the SEC noted that there was a lot of concern because a lot of PSUs or other performance awards are multiple year awards. And if you only measured on vesting, it may not tell an accurate story. So they gave the easy example of you have 2 years of great performance and then a third year that's really poor. But overall, the PSUs pay out. And if you only then record the PSUs in that third year, it would then record an increase in comp for those PSUs in a year in which the performance was down. And they're like, it would look both like the person didn't get rewarded for the 2 good years, but then incorrectly got rewarded during a down year. So to fix that, they're trying to make this work on a year-by-year basis so that through the date of vesting, every year you record the fair value of the equity award as of the last day of the year in which it's not yet vested. And then from year to year, you do an increase or decrease. And the concept would be, for example, with PSUs, if you run a fair value, if it's based on TSR, at the end of the year, if the TSR looks good and the PSU is more likely to be attained, it would increase the fair value of the award as of the last day of the year. Whereas if it's down, it would decrease the fair value. And then the next year, you don't record the whole value of the award again, you record the increase or decrease. So if next year TSR goes down, you'd actually end up subtracting value for that award if the fair value goes down. And the idea being it will more closely approximate the value earned in every given year compared to the actual performance. And you do that through the year of vesting. And I think we all have to kind of see how this plays out over a few years, but at least conceptually, this approach makes more sense to me than what they proposed in the proposed rule. So this seems like a good change and like it will more accurately. One hiccup here I do want to note, at least it's coming to mind for me though, is multi-year non-equity incentive awards are still going to have that problem that they noted because those are not getting subtracted out and added back in this way. And so they will hit in the final year of a performance period, and they may end up showing the way that, and so I don't know of a solution for that yet, but if you have multiple year non-equity incentive awards, so the cash awards, I think that's something to start thinking through as well, because that may end up showing a hiccup one way or another. But I think for the equity awards, so I'll go ahead a couple of slides here. These are the rules. I won't read through all of them. Go ahead again, one more slide if you would. Yeah. The one concept here I also want to note is again, executive compensation on the compensation side. Vesting is something we spend half of our lives considering and defining and thinking through when something vested, when's it not vested for federal income tax purposes. And a lot of you on the line do this too, right? It's a huge concept and it's very hard to pin down. And to make things even worse, different sections of the code have different definitions. So it may be vested for 409A and not 483, or 483 and not 409A, and then there's 457, and all these different concepts. The SEC does not define this at all for these rules. And in fact, they say something like when all conditions are satisfied. But again, in the tax side, there's a lot of conditions that are not satisfied, but an award may still be considered vested. So I think, and there are other tables in the SEC under item 402 that require concepts of vesting as well. But I think those historically have been simpler because it's been like for the RSUs or PSUs that are settled during a year. I think a lot of companies just use the value, the tax value, when the person receives the shares. But for this one, it specifically uses the fair value as of the date of vesting. And again, that may not be the date that they get the shares, and it may not be the taxable income. So I think clients need to start considering the rewards and coming up with a theory of when they're going to consider rewards vested for purposes of this rule. And again, once they become vested, that's the final time you include an equity award in this table. And the good news about that is it comes off the table after that year. But the bad news is if they ultimately forfeit it, if you considered it vested and then later they forfeit it for another reason, you wouldn't get credit for that. You wouldn't be able to take it off. Or consequently, if they increase, you wouldn't get credit for the increase. And so it's the vesting's the final date, so it's important, but I think there's some balancing considerations that need to go in. Go ahead, next slide.
And then Ryan, would it?
Oh yeah.
Not to interrupt you, but
Yeah.
would it be once a company decides what they're going to use for their quote unquote vesting date, then it would just be a disclosure matter of this is how we determine the vesting date?
Yeah, I think so. I think just describing it and making sure it's consistent with the other tables that have a concept of vesting, and that it makes sense. And here's an example I came up with. This is not an unusual example for a public company, but I wanted to show sort of at least an easy example of it not being as simple as it seems. Like if you do a 3-year RSU that would become vested if an executive retires, but the RSUs don't distribute until 1 year after the 3-year anniversary, and then they're subject to clawback for 2 years. Well, there's a lot of different conditions there. The person doesn't have shares free of any restrictions for 6 years, actually, from the date of grant. 3-year period of vesting, 1 year till distribution, 2 more years of clawback. From a tax perspective, if the person satisfies retirement, we all know that would be considered vested on day one for tax purposes. That doesn't seem consistent with what they're going for here. It could be considered vested at the end of the 3 years when it's distributed, or ultimately at the end after the clawback period. My gut is that the SEC thinks the 3-year point is when this would make sense, that you would run an RSU for the 3 years. But again, there's nothing clear in the guidance on this. So I wanted to give an example. There's a million variations of this example. I have a lot of clients that wait to distribute shares until after vesting. A lot of public companies have clawbacks now. So there's a lot of different variations of this that'll be true for a lot of different companies. So, and there's a couple more slides on this example. This is just a continuation of those same thoughts. So then go one more slide. The last bit I want to cover here at a high level is above market earnings. If you have a deferred comp plan that has above market earnings, you have to report that separately here. The only thing I can think of, I don't actually know of any companies in my client group that does this. So I don't think this will impact a lot of companies. My sense here is that this is intended to be a catch-all so that somebody couldn't disguise extra pay for executives as above market earning in a non-qualified plan and avoid needing to disclose it. So I think they probably put it in just to make sure it's a catch-all, that nobody's doing this as a way to avoid disclosing comp that should otherwise be disclosed. But again, I don't actually have any clients that do this, so hopefully this won't impact a lot of companies. The other part I want to note here, one of the reasons the SEC said that they wanted this included even whether or not it's paid is if you read the last bullet there, they note that if you did it when it was paid, it would be when the executive decides to withdraw, take the distribution. And again, I laughed because those of us on the comp side all know for 490, they can't choose when they get it from a non-qualified plan. So that actually is not an issue. And so again, I sort of laugh when the securities attorneys are sort of drafting for comp related issues. Sometimes it's very clear that they're not knee deep in the world of comp like a lot of us are, because they were worried about executives just selecting when they take their distribution. And we all know they can't do that. So, okay, next slide. And just for time, I'm going to kick through a lot of this. We have a lot of different things on the pay versus performance table. And I want to note one more thing. If you have any one-time payments, they have to go in here as well. They have to be added in. So again, you can't hide comp. Then I'm going to go through the measures of performance because those are more SEC related. We're happy to cover them, but I want to be sensitive to time and make sure we can get to some of our other topics. So go ahead and go through to the final thoughts, if you would. The one thing I'll note, so here, I want to make sure we cover these, and Debbie has a chance too to add any thoughts, but a couple of just really important things on this pay versus performance. You already could start calculating for the last 2 years. So there's a transition rule for public companies. It's 5 years ultimately, but this first year you only have to do 3 years, which will be 2022 2021 and 2020 for calendar year filers. So you could already start calculating all the values needed for 2021 and 2020, which at least we all think then will get everyone fully familiar with the rules, and then calculating 2022 will be easy. We think, a lot of you will have comp committee meetings in November. So again, we're hoping this timing is helpful. I think this should be a topic for your comp committee at the November meeting so that they know this is coming. They have a sense, and you can start to get decisions from them. One of the decision points is the peer group selection for the relative TSR. And there's some limitations on what you can choose for that purpose. But it will make a difference, and you want to make sure the comp committee is comfortable with that decision. So I think that should be previewed in November, if not decided in November. The vesting issue we talked about, I think you need to start figuring out how you're going to apply those rules, because you can't calculate 2021 and 2020 until you make decisions on the vesting. And then I noted earlier the tension of this table and the growth of ESG goals. Fred Cook notes 64% now of large companies disclose ESG metrics and incentive plans. So vast majority are using qualitative rather than quantitative, which is what I think puts it in tension with this requirement, because this requirement is intended to be quantitative. Let me pause there. Debbie, any other thoughts? I'll turn it over to you, but if you want to add anything and then jump into the next topic.
Yeah, I just think that, this is maybe going to give comp committees some anxiety, because they may feel some kind of pressure to try to design their performance-based comp to mirror what's going on with this table. But yet that might not be the right thing for the company itself. So there's going to be that tension there, I think. And I think that's why earlier discussions, the better, because that way at least it opens it up for them to think about what they want to do. And do we know at this point, I'm assuming we don't, what ISS is going to do with any of this information?
No, not that I'm aware of either. I don't think they've come forward on it either. But I agree. It's definitely, it's going to have to factor in, right? Because in a way, this is almost, you can see it as an attempt at almost a grade sheet for the comp committee, right? It's almost a way of saying, you've been saying for years you're going to pay for performance, and now this is our attempt to say you're actually doing that or you're not doing that. So I agree with the tension, and I think ISS will certainly come out, but maybe it'll just be on a case by cases for them. Maybe they'll just react to what they see, and they may ding a company and may not. I don't know, but I'm not aware yet either that they've said anything.
Okay, well, let's move on to the next topic. Thanks for talking about the 2-ton elephant. But as compensation people, we know that we can't just focus on one thing. We're masters of juggling many. And the first thing we wanted to talk about is the new buyback tax that was implemented. And you may think, well, this really isn't an executive comp or even compensation question, because the buyback tax imposes a 1% excise tax on most buybacks by domestic public corporations, and it's not certainly limited to the compensation sense. Just as a little background, it starts into effect January 1st. There's no grandfathering, so any buybacks undertaken starting January 1st have to go into the calculation of whether a tax is due. And essentially the way the tax works in the simplest way is that the tax that is imposed on the value of the stock of a covered corporation that's repurchased during a calendar year. And if that amount is offset then by the value of any new issuances during that calendar year. Next slide. Covered corporation, again, is publicly traded U.S. corporation with certain exceptions. And there's certain exceptions from the repurchases, like contributions to retirement plans and repurchases in the aggregate that don't exceed $1 million. But a repurchase is defined extremely broadly, and it pretty much covers any repurchase that's done by a corporation, including from the employees of that corporation. So in the executive comp area, this could come up very easily in connection with equity awards, where there's a net exercise of a stock option and the company's effectively buying back those shares that are used to pay the exercise price. And in other equity awards where shares are used to pay the withholding tax, because essentially the company's buying back that stock to then turn the money over to the IRS. That type of repurchase is not covered by the exceptions unless in the aggregate it's $1 million or less than $1 million. Next slide, please. Generally in the executive comp area and the equity awards in particular, we wouldn't think this would have a huge impact on the amount of the buybacks, but mainly because the amount of the shares bought back should be offset in most cases by the number of shares issued in connection with the award. But caution that you need to keep track of those buybacks for purposes of the company's overall buyback rate, because they have to go into the aggregate amount. And so that's something else that the HR people are going to have to keep track of where they didn't have to before. There will be regulations issued under this provision, but I doubt that they're going to come out before December, but I guess we'll see. Next slide. Next slide. Another topic Ryan alluded to was clawbacks. These have been around for a long time, but Dodd-Frank in 2010 issued a rule to the SEC saying that the SEC had to adopt listing requirements for companies that were listed on the exchange, that they had to put in a clawback policy. And there was proposed rule issued in 2015, and then really nothing happened. Although that particular proposed rule required clawbacks of compensation for the NEOs for anything that had happened 3 years prior to the restatement, and it covered only material restatements caused by material misstatements. In November of 2021, the SEC issued a new proposed rule and requested comments. And in that particular rule, they suggested that they were considering broadening the scope of the restatements that were going to be covered by the clawback requirements to include what are sometimes called little r restatements, which are those that are required to correct errors that were not material to a prior financial statement, but that would result in material misstatements if they were left uncorrected in the current period, or if the correction was recognized in the current period. So they were broadening the scope. Their view was that all types of restatements should be covered by these rules. In June of this year, the SEC announced for the third time the reopening of the comment period. And that comment period expired on July 14th, 2022. Next slide. So this all seems to suggest the SEC is getting serious about these clawback rules coming out. In connection with the last reopening of the comment period, they did not change the rule, but they did issue a staff memo from the Division of Economic and Risk Analysis, or DERA, which summarized a couple points. One was DERA concluded that since the original publication of the proposed rule in 2015, the number and percentage of issuers who have disclosed a clawback policy has roughly doubled. So their view is that, well, the cost of putting this rule in should be reduced and it shouldn't be that much work because people are already doing this, putting aside that what the clawback policies look like may not be what the new rule is going to come out with. And then the DERA memo also concluded that broadening the types of restatements to include these little r restatements is going to about triple the number of restatements that have to be considered. And the idea is that once the restatement rule goes in, the companies are going to have to report that they have the clawback policy, what it is. If they do clawbacks, they have to report the amount. And under the most recent incarnation of the proposed rule, they also have to report how they calculated the amount of the clawback, which was a new add in the most recent proposed rule from 2021. Next slide. So again, as executive comp people or HR people, why do we care about this? Well, ISS has always taken, or in recent memory, has taken into account in its equity plan scorecard whether or not the company has a clawback policy. So this is kind of old news in that regard. But if they put in a new clawback policy that is broader than what is required, we would expect that ISS will look into the substance of that and make sure that it covers what it's supposed to cover. Even right now, if a company just has a clawback that says we'll comply with Dodd-Frank, they're going to get 0 for their equity comp scorecard under the heading of clawback policies. So that's coming down the pipe. Also, similar to the pay versus performance, the boards and comp committees should be kept up to date on this, because they're going to have to consider what kind of clawback policies they may put in if these rules become effective. You might have clawback policies in existing plans, or you might have them freestanding, and those need to be looked at, and companies no doubt are going to be looking to the HR people to assist with this. And some commentators, I think personally, think this isn't a big deal, but I just wanted to raise it in case you all hear it, that somehow these clawback policies are going to affect recruitment by public companies, on the theory that the talent could go to a non-public company, which isn't subject to the clawback policy rules, versus a public company. I just don't see that as being a realistic determinative factor, but it's a possibility. So next slide, and Ryan, I think you're going to take over here.
Yeah, I'll jump back in. Thanks. And I, just for the clawback part too, because I agree, and I'm glad we're covering it. I think just historically, a lot of companies that have voluntarily adopted clawbacks have been for things that involve fault and a restatement. So it's sort of a combination of somebody does something and the company does a restatement, then that person's comp can be clawed back. It's usually some variation of that, of a concept of fault and restatement. The SEC's rules, when they put them out, I think based on the proposed rule, we all expect to be a concept of a restatement without regard to fault. So if the company has to do a restatement and you are overpaid, then you're going to have to give back the comp, or your executives are going to have to give back the comp that the restatement indicated should not have been paid to you to begin with. The part I want to raise for companies, again, just to consider, and we've talked about this the last few years, but I always think it's worth mentioning in today's climate with executives, and a lot of bad publicity that companies take sometimes for acts that emerge that their executives have taken, is just to review your cause concept and whether or not clawback should include fault situations that do not involve a restatement. So just bad acts on the part of an executive that end up really hurting the company reputationally or financially, and whether that should be included clearly as a cause concept, so it could trigger forfeiture and or a clawback. So that to me is the one area, at least, I don't expect to be addressed by the SEC rules, and I don't think historically all companies have addressed. So if you haven't done that, just consider it, because I always feel like it would be a really rough meeting if you're at a company where you have to meet with the comp committee and say that you have to pay someone that did horrible things and is, really hurting the company reputationally, but you don't have contractual provisions that allow you to either trigger cause and or potentially a clawback. My own 2 cents, but I think it's worth thinking about. So just a couple of quick cases. I won't spend much time on these. One was a shareholder breach contract where a company, actually public company, paid an executive in excess of the plan limitations. So they had a limit on how much a person could be awarded per year, and they exceeded that. And the shareholders sued on a breach of contract. The only reason I raise this again is that, just always reread your plan. You have to, it becomes the law of the land once shareholders have approved it, and you have to follow it. just a case again showing that they can enforce it if you don't. The second one was a drafting point. Sort of the nightmare for all of us when we do drafting is thinking through sometimes something as simple as a conjunction, but I included the language and you can look at it. The whole fight was whether the and was intended to the meaning of the word and it is sort of a funny situation, or not funny, it's the nightmare situation. Be careful when you're drafting, but it's you can see both readings as being ambiguously applicable, which is when it says for this period to apply after a termination and a breach of restrictive covenant, does the period apply for 6 months after a termination and then for 6 months again after a restrictive breach? Or is it for 6 months after you both have a termination and a restrictive covenant breach? And the facts where you had one and not the other, for what it's worth, the court interpreted it to be 6 months after both events and did not interpret it to mean you had to have both events before you could enforce it. But just again, drafting points to make sure your docs are clear on some of these. So I included that one somewhat as a, the nightmare we all dread, but should all think through as we're drafting. Okay, next slide. So now we're going to hit some private company concepts and some points I want to make sure we cover. And just noting up front again, public and private companies are trying to pay for performance. That's the theory. The big difference is public company shareholders are diverse and have a range of interests. They have a very different, they have an unknown investment horizon. You may have short-term investors, long-term holders, and everybody's served when the company gains value, but sometimes short-term value versus long-term value can be a debate, and there's different interests, right? And so public companies mitigate that by making annual grants year to year, and that they can change year to year. So the comp sort of also follows more of a repetitive unknown horizon similar to the investors, whereas private companies, at least on the PE side, but also on the private side with other investors like venture capital investors, you have a very specific set of investors with a very specific timeline on return, and it can be very specifically measured. And so the executive comp often is one-time grants that are intended to maximize the investment of very specific investors. The disadvantage of that approach is it's harder to reward executives who leave midstream or join the company midstream because they've already missed part of the return that those investors are, hopefully they've missed part of the return the company's doing well, but it's a little bit more difficult. So next slide, I want to talk through, on the executive side, I always want to point this out, that one advantage private companies have over public companies is that in an ideal world, I've done this long enough. If an executive could choose, they want tax deferral until they sell equity, they want capital gain treatment rather than ordinary income, and they don't want to have to put more personal money at risk. You cannot get all three of those in a corporation. It's not possible. But for profits interests, which are often the vehicle used by private equity, you actually can get close to these three goals. So that's one huge advantage some private companies have in the executive comp world, is that profits interest can get them close to all three of those goals.
Right.
And so
Maybe
I
I'll
want
just jump in
go ahead.
and mention what a profits interest is in case people don't know. Real quick.
Yes, please.
It's basically a non-capital interest, but it is a property interest that entitles the person to an amount equal to the growth, some percentage of the growth of the profit of the company, determined under a formula, after the date on which the award is granted. So the award is granted with a threshold equal to the value of the company on the date of grant, determined under appropriate circumstances. And then when it's paid out, usually on an exit event, cash event, or change in control or something of that nature, then they get paid. And because it's a property interest, the individual can make an 83B election, which is an election to be taxed on the value at the time of grant, which is 0. And then any of the stream of income that they receive is then taxed as capital gains. So kind of to your point, it's deferring the payment until they actually get paid, and it's converting what might otherwise be compensation income to capital gains tax.
Perfect, thanks. Yeah, and you can only do that on a pass-through structure. So either an LLC taxes a partnership or a true partnership is the only place you can do that. On the corporate side, you can't get an executive capital gain tax treatment unless they put some money at risk. The amount of money that needs to be put at risk varies based on the value of the company. Early stage companies, there may be ways to do it because the company's not worth much when they're buying into the capital. So it might be a lot more possible, but for public companies, as many of you know, it's almost always ordinary income tax because you can't put enough capital in to avoid ordinary income tax treatment. I want to mention incentive stock options because for private companies that are smaller or for some employees, that's the closest you can get to the treatment that profits interests get. But to get incentive stock option, the special tax treatment, the person has to exercise and hold the shares for a year. So they have to actually invest and put the money at risk for one entire year before they get the special tax treatment. Okay, slide. So I thought it would be good just to kind of do 3 or 4 different categories of private companies and what we typically see, and then note an issue or 2 for each one that I want to make sure people are aware of. So for private companies, early stage, on the cash side, it's typically very low for very obvious reasons. There isn't much cash. I want to flag one issue here that comes up frequently for us, though, which is the no good deed goes unpunished. You have executives of a startup, and to be nice, they say, I'll waive my salary until the company earns so much per year, or the company has this amount of cash. So I won't get paid for these first few years, but when this amount of cash comes through, then I want my salary and I want my back pay. And that actually is a 409A violation. And it's one of those, we get that call frequently where it's like, wow, you did that to help the company. And in the end, it creates a tax issue. If any of you have that fact pattern, calling sooner rather than later, there may be fixes that are available. But that can be an issue if somebody agrees to waive cash comp until the company grows. And then stock wise, it's typically restricted stock for founders, and then stock options often also for founders or other employees. And again, incentive stock options can be the best treatment. The one other part that can be helpful, and I put it down for the venture company or venture capital investors, but also possibly exercising options early and then making a Section 83B election can allow people to get capital gain tax treatment. That's a very frequent feature in the tech world. So the Northern California or other areas now where the tech industry is growing, that's a very frequent feature that's used to try and get people capital gain rather than ordinary income. But to make that work, again, somebody has to buy the shares and put their capital at risk. So then on the venture capital side, so you have a private company that's growing, you do different rounds of investments. The salary and the bonus is, again, typically much lower than a public company, but starting to grow. Stock options are, in my experience, still the preferred vehicle for most companies. When investors come in, they'll grant new stock options. The advantage of stock options is that they only have value if the company continues to grow, which for the venture capital investors is an alignment because they want to see their investment grow. So often options are used. The problem that comes in, this is one of those points I want to note. If you're facing this, later stage private companies that are very valuable start to see less upside available with the granting of options and feel like they don't have the same retention value. So employees who are there early and the options are worth a ton of money, you have no problem. They're going to stay. They want to see those options cash out. But people who come later to the company and feel like, wow, those options will never be worth the same. I came here too late. They start to want to switch to RSUs. The problem for RSUs with public companies or private companies, is that they can create taxable events at a point when there's no liquidity in the stock. And Facebook came up with this solution. So I'm labeling them Facebook RSUs, but a lot of other private companies have done it where they try this thread the needle to have RSUs that become vested when the company becomes liquid, either through an IPO or a change of control. And an IPO, for those of you who know 409A well, is not a payment event for 409A. So they do it by trying to take this position that the IPO is a performance condition and it's short-term deferral. But I've encountered different RSU agreements that take this approach that are not drafted correctly and actually have 409A issues. So if you're considering this as a later stage private company, or if you currently have them, I would recommend getting them reviewed before you go into the event, because if there are issues, again, the sooner you fix them, the better. But they're gaining popularity, and I see them more frequently than I used to. So I wanted to note those. One other issue I wanted to note is late stage private companies that face liquidity issues for founders. So as you have a company that moves from the top category to the bottom, and founders want to cash out as more investors are coming in, you run into a problem, and the problem works as follows. Founders want to sell to investors. Investors, they'll want preferred stock, and the founders hold common. And the founders want to sell their stock for the price that the investors are paying for the preferred, but they hold common. If the founders sell the stock at that enhanced price, you have a problem for 409A for stock options, because then it looks like your common is worth that amount. And if you grant options for less than that, it'll look like you're doing discounted options, which creates a 409A problem. So we have people call all the time on this issue. There's this issue, I call it FF stock. That's what it's sort of called. If you Google FF stock, or we can work with you on this, we've done it now for some clients, which is you create a class of stock for the founders that is common, but when sold, sells with the attributes of the preferred. So it's a different class, so it can sell. This only works for founders or people you're willing to give a different class of stock to, but you can recategorize some of their common as this FF stock. And then if they sell it to investors, they can sell it at the higher price, and you can take the position correctly that it's different stock than what the common is. And so it doesn't put the same pressure on your 409A valuation. So this is one of those issues I hadn't tuned into a couple of years ago. And now I've been on several calls with companies facing this issue because they have founders who want to sell to investors, and they have this price pressure point. Okay, slide. We're nearing the end of our time. This is our last slide. The one other part I'll note here is on the PE world, they typically use profits interest for the most senior because of the reasons we articulated before and Debbie described. And it's the sort of best case scenario tax treatment. There are disadvantages of profits interest in that the person becomes a partner, and so it can be complicated for a tax return. And so if the PE fund has, or the company has an operating subsidiary that's a C Corp, sometimes you'll see stock options still granted at the C Corp level. And then often you have a one-time capital investment for certain executives where the PE firm may want them to co-invest for a certain amount. So we see that frequently too, but often just a one-time. And then I had included public companies.
Also, Ryan,
oh, go ahead, Debbie,
before we move on, sorry.
Yeah,
In the profits interest world, another structure that's common is that the profits interest would be given to at the holding company level, because it would have to be a partnership or LLC taxed as a partnership. And then the operating company is where the people are employed, because you can't be an employee and a partner of the same entity. And so you wouldn't want to make them partners and provide them with partner level benefits, comp, and other things for their actual services. So that's a very common structure in the non-public company arena, using profits interests.
Yeah, no, thanks. I'm glad you raised that, because it is something we see. And honestly, we see it at times in corporate deals where companies have been doing that incorrectly. So it's worth noting, because it can put pressure also on your qualified plans. If you're incorrectly carrying someone is an employee who should be a partner, and so making sure it's structured correctly so that they can be an employee of the sub and a partner of the parent is important for tax purposes, but also for the benefit plans. So good point. And I know we're up against time. I'll turn it back over to you, Debbie. We're at the hour. And I'll just note, you'll probably note this too, if anyone has any questions on any of these topics, feel free to reach back out. I know